Welcome to Killik & Co.'s podcast for the 3rd of June. May ultimately proved to be quite a volatile month. For the first 2 weeks of the month we saw very strong gains across global equity markets. Indeed, here in the UK, the FTSE 100 added over 450 points through to the 22nd of May, but it was volatility that started in Japan and also resulted in an increase in the 10-year Treasury yield that caused initially some profit taking and ended up with the month with some fairly significant falls from the peak. We didn't erase all of May's gains. Indeed, we still ended up quite comfortably on the month, but it certainly has caused a change of sentiment. This week will be interesting because a number of the features that drove the volatility last month, including interest rates expectations, we'll be hearing from the US and in terms of job numbers, which is clearly a key piece of economic data that is driving the QE programs in the US, and here in the UK and indeed in Europe we'll be hearing about current interest rate decisions. The thoughts of a further cut in the ECB may well have been quashed by this morning's data that is coming out of Europe. It's PMI data. This is the forward-looking purchasing managers index, and particularly in Spain that number came through much higher than expected, seeing a sort of 2-year high print in Spain, but sort of good data coming out also from Italy, France and Germany this morning. So any thoughts that of an early rate cut may well have been put on hold, and it does mean the euro is strengthening a little bit this morning. So a quick look at the diary itself. As I mentioned, we will have UK data out from construction, retail sales and services data here in the UK. So an interesting week for sterling. Sterling did sort of get down to a low last week of around 150 against the dollar, has bounced to around 152 at the moment. In terms of company news, it is a little bit thin on the UK data scene at the moment, so moving back towards the macro environment where we'll pick up things this morning. So really this is the main chart that I think had investors looking for a sort of change of view. This is the 10-year yield chart, which is relating to the US Treasuries, and we can see that during the course of the month this sort of trend lower, which was being driven as I say by sort of continued QE programs, feeling that the Fed would continue to keep foot firmly on the accelerator of QE. We had some data out from the US which indicated that the US economy was rebounding quite strongly, and we've seen a very sharp reversal in the yields there, moving from 1.6-ish up to 2.14. It did top out around 2.2 at one point during the course of the month. Now clearly this comes back to the theme we've been talking about for a while now, which is that relating economic growth, economic recovery with stock markets. Really the markets have been moving in slightly different directions, and it's been driven by the fact that yields on these instruments such as 10-year treasuries provide the sort of benchmark on which most other assets are valued. And of course, as you start to get rising yields in bonds at the moment, it starts to dissipate some of the attractions of equities the higher that moves up. Now, for our own feeling, I think the yield would have to move quite a long way to do damage to the stock prices at the moment. So whilst in the near term it's creating volatility in stocks, I don't think it changes the underlying story of where stocks still look very attractive relative to the 10-year yields on treasuries, as an example. So whilst we've seen a sharp move up at the moment, I think it's not necessarily a trend changer just at this point. So let's take a look at some of the other sort of key features, and Japan has clearly been a key feature for markets over the course of this year. It's been the strongest performing stock market, but the profit taking is proving to be the most severe. Indeed, just this morning we saw another 3% taken off the Nikkei this morning. Most other markets are sort of down, but not by the magnitude of Japan at the moment, and so we're certainly given we're certainly given some of that sort of gain back, but want to at least put this move into some sort of context that whilst the dramas of the last few days have been induced by this volatility at the moment, the Japanese market remains very much towards the best performing market of this year. Japan 10-year yields at the moment at around 0.8% have receded somewhat from the highs at the moment. So I think, from my point of view, that the worst of this sort of profit taking is now over. We're going through a volatile patch, but actually some of the reasons for the profit taking seem to have dissipated at the moment, so we may be in for a slightly calmer week on that index. Just a couple of sort of more sort of niche areas of interest. I just mentioned Turkey. This is the Turkish stock market. Down around 5% today on the back of the protests that we have seen. It's a fast-growing economy and one where the stock market has been buoyant up until late. But these protests, which started out focusing on really development within the city centre, has taken on a much wider meaning at the moment. And as a result of that, I do feel that there are sort of question marks about sort of government within Turkey, and that has caused the wider spread falls there this morning of around 5%. Just coming back to the sort of bond story, one sector that does get impacted by the bond market moves more than almost any other is the utility sector. Utilities are often described as bond proxies. They benefit from high cash flows and they tend to distribute a high proportion of their cash out in the form of dividends, and National Grid certainly has been the sort of biggest proxy for that particular trade. And you can see there the sort of unusual movement that we've seen in the equity at the moment, and again just highlighting this relationship at the moment between Fed QE and equity valuations, and no more so, as I say, than in the utility sector at the moment. It does lead me to sort of wonder about the situation at Severn Trent. Severn Trent saw a very sharp jump on a sort of discussions of a potential bid from a consortium of Middle Eastern investors for Severn Trent at the moment. The initial bid has been rejected by management. The expectation, it came in somewhere between 18 and 19 pounds a share. The market is betting on a higher bid. Indeed, thoughts that 20, 21 pounds. But I can't help feeling that the large part of that bid sort of talk is in the price with Severn Trent at the moment. We obviously do run the risk that could be competing bids may take it higher, but on the basis that last chart I showed you on National Grid, utility stocks have given up a large proportion of their gains for this year on this bond proxy move. Given the consortium, I suspect a slightly upper hand in terms of negotiation should a bid materialise. If the talks fall apart, I would expect that price to come sort of rattling back, certainly to 18 pounds on the back of that. So I see more downside risk to Severn Trent than upside at this stage, and one we would be locking in some gains.